Good morning, everybody. My name is Sarah Bettridge, and I wanted to welcome you to the second webinar of our Investor Readiness Program. These webinars form part of the Investor Readiness Program, which BDO is doing in collaboration with Department of Primary Industries and Regional Development. In addition to the webinars, we are providing 4 practical masterclasses in Busselton and Geraldton, which will be starting next month in April. The registration for these full-day masterclasses are on Eventbrite and free to register should you wish to attend. Additionally, there will be online resources released during the program period, which will be available on the Department of Primary Industries and Regional Development's website. These documents will assist you in becoming investor ready and navigate the capital raising process, so be sure to look out for these also. Throughout this 3-part webinar series, we'll be discussing the main key elements of investor readiness, which can be broken up into 2 parts, being the path to becoming investor ready and navigation of the capital raising process once you are ready. Today's presenter is Danny Olsen, who'll be focusing on the path to becoming investor ready and what you need to consider before approaching investors. If you missed our last session, which was on the capital raising process with Todd Grover, and you would like to watch it, you can head to our website and search Investor Readiness. Our final webinar will be next month with Margot Beauchamp. In this webinar, she'll be putting all the principles you've learned from Todd and Danny to practice by taking you through a real-life case study. If you have any questions about the program, please reach out to either myself or the Department of Primary Industries and Regional Development. I'll now pass you on to our expert in tax and business advisory, Danny Olsen. Danny's been with BDO for over 10 years. He has a proven track record in helping our clients navigate the increasing complexities of tax and accounting. Without further ado, I will hand you over to Danny.
Thanks, Sarah. Okay, so just skipping through the slides. Okay, so thanks for attending today. The irony of presenting an investor readiness webinar on the day of the worst market slip since 1987 hasn't slipped me, but it does really highlight the importance of having a market ready and people and businesses ready to accept investment from investors rather than your traditional lending criteria and banks and the like. So a little bit about me. I'm a partner at BDO in the Business Services Division. My principal focus is really in helping my clients and the people in at BDO to help our clients to grow businesses, scale and increase their wealth. We do that through multiple channels, whether that be through helping them develop strategies to grow, helping them to become more profitable, or assisting them in relation to optimizing their tax structures and outcomes. So a little bit about BDO. So there's 1,617 offices in 167 countries, over 88,000 people, with a global revenue of $9.6 billion. However, in WA, we're a locally owned practice who focuses very heavily on the SME clients. Our practice of about 40 people really assists people anywhere from people that are salary and wage earners all the way through to businesses of turnover up to $100 million, everything in between. Okay, hopefully, in addition to being a partner here at BDO, I've helped multiple clients start up and invested in a number of startup businesses and scale-up businesses throughout the journey. So I've felt what it's like as a business owner to have skin in the game and been successful in a few occasions in taking businesses and reaching a point that we'd hoped to achieve in our original goal setting and objectives. Some of those are now being reset and continuing to grow. So a lot of the principles I'm applying here I've applied in practice, and hopefully I can add some value to you and your businesses today. Okay, so just a recap on Todd Grover's presentation, and which you may or may not have heard 2 weeks ago, but I think the critical thing is to understand that capital raising from investors is different to selling. The idea of capital raising for investors is that you're going to continue in the business and help it grow, and you're developing a different value proposition for the investors to come into the business. in addition to that, the key questions you need to ask at the time of capital raising, of which there's 4, what does your business do? Why does it exist? How much money do you want? And what are you going to do with it? What do I get? What does the investor get? And when are the investors likely to get their money back? So at the time when you start the capital raising journey, you want to have those questions answered. And really what we're talking about today is the lead up to that position and how you can get those answers to the questions and be clear when you come to get investment. One of the key things that's different, I suppose, than operating a business in the normal circumstances, when you come to ask for investment, you really need to be able to support your position. Having materials, documents, and evidence to support what it is that what your value proposition is going to be critical. The general view that investors take is first to trust, but then to come back and verify. So if you have that in mind, that they'll trust you in the first instance, so you can speak with a level of authority about your business, but they will come back to verify against the data you're providing, then that'll give you a good starting point for how to approach these circumstances. The other thing is to have a long-term view. Where you're going to source your funds from is critical. And understanding what the investor's intentions are is critical in you being successful in achieving the strategy that you have. That's a recap on Todd's presentation. Okay, so there's three circumstances in which we see people starting to look for investment. The first is a startup business that's got an idea. They want to turn that into a business. They want to be able to find, see their way through, create something from scratch, and those businesses are generally got a high level of growth and a high level of return, but a high level of risk as well. The second circumstance is where a business idea has been turned into something that's generating revenue. It may or may not have employed people, but it's really time for that business to be turned into something that's going to grow. The last circumstance in which you look for investment, which is one we're not going to cover in too much detail today, is when you're looking at exit. That's a plan to succeed yourself out of the business, either out of operations or out of ownership. And obviously, a lot of the same principles will apply to the first 2 steps, or the first 2 examples. Okay, so there's no defined definition of investor readiness that I can find that gives you a full picture of it, and different people have different views. But ultimately, I suppose we look at it in kind of 4 ways. It's your ability at any point in time, or at a point in time, to attract investment from an investor, to accept the investment from the investor, and to successfully negotiate terms that are attractive to the business and the business owner. In addition, it's also your readiness to utilize those funds that are received to deliver on the value proposition that you're offering the investor, and to take those funds and execute on the strategy and the strategic initiatives that you put forward. So there's a process you can step through. The first is assessing your readiness. So we'll have a investor ready checklist for you to run through on the website. And we'd encourage you to look at that and assess your own readiness. We'll be available if you've got any questions in around that, as will the team at DPIRD. The next is to take your investor readiness and start working on the fundamental elements in your business. Now, obviously, there's a lot of different things you can focus in at any point in time in order to grow a business, but it's critical to really come down to the top 3 or 4, because these processes can be time consuming, they can be laborious, they can be expensive. So it's critical to understand what you're trying to achieve from the get-go, not to just run off and try and implement everything at the same time. Okay, the next is this process that Todd started to cover off on with you in the last webinar, and that's the capital raising journey. The capital raising journey has got a number of elements to it. The critical thing is that it's very unlikely that an investor is going to take data at a point in time and extrapolate that out to any large degree. So it's important that that capital raising journey actually starts as soon as you've assessed your investor readiness, if you've made the decision to raise capital. The earlier you start, the more likelihood you'll get engagement from the investor and you'll get a better outcome. Post capital raising, you start your growth and your expansion journey, and then potentially, if that's part of your goal, through to exit. Okay, the focus of today's session is on the first two steps, on assessing your readiness, but also understanding the fundamental elements in investor readiness. Okay, so what are the fundamental elements, or how do we look at them? Business strategy. Having a clearly defined business strategy is critical. The main aspect of having a clearly defined strategy is being able to consistently explain it to an investor, and for that to be supported by the underlying documents. One of the critical things that an investor will look at, and probably the biggest risk to you getting the investment, is your financial performance and your financial acumen. Understanding your numbers and being around the finances and the data is critical to any investor. They'll attribute a high degree of risk if you're not around those things. The next step is get your legals right. That's everything from your structure, understanding how you're protecting your assets, your IP, and so on and so forth. But they'll look at the legal structure to make sure they know what they're getting. Now, obviously, the most important asset in most businesses is the people. Now, people can be your employees, it can be your leadership group. In some cases, it'll be your family. But it's critical that you lock down your people in the right positions in the business, you have your structure right, and they're fulfilling the right roles. Finally, processes and having documented processes provide a lot of security for investors, particularly having a good understanding about the processes that go through your business and how they create value for customers. They also will dictate how much waste sits within your business, and that'll provide opportunity for you to get more profit and to deliver more value to customers. Okay, so business strategy can be a bit of a difficult thing for people to get their heads around. There's difference of opinions across the board as to what business strategy is. So when we talk about business strategy, we like to break it down into 4 different steps. The first is strategic thinking. So a lot of the tools that you see out there are really just are there to help you think about your business and think about the environment that you're operating in. The key thing with strategy is to decide, to have a choice, to make choices. Once you've made the choices, you can step forward with planning and then taking action. So what is a strategic planning process? The first is to understand the history and where you are now. So that this will include things like preparing mission statements, describing your business, understanding what your competitive advantages in market, doing an analysis of your strengths, weaknesses, opportunities, and threats, understanding the environment you're operating in, particularly at the moment with significant changes happening in the global world. Understanding your environment, the environment, and how that's going to impact on your business is going to be critical. Over the last 2 days, I've fielded an obscene amount of calls around the government initiatives to stimulate the economy. So the political and economic environment right now is important to understand. Then it's things like your organisational culture. Do you have a high performance culture? Does everyone understand what they need to do in the business and what you stand for? Once you've understood the history, it's really about saying, well, what can we be in the future? So doing some big picture planning and setting some big goals for the future that'll hopefully be realistic, but then also setting a vision for the future that people can believe in and the investors can believe in is critical to obtaining funding for your ideas or your potential growth plan. And one of the critical ways of looking at stepping through to getting investment is to give consideration to 3 elements. What is the opportunity and what's the size of it? How much time do you have to take the opportunity? So in some circumstances, your opportunity or the time you have to obtain the opportunity can be impacted by things like your cash flow, by projects and contracts that you may or may not be awarded, or by critical relationships you have. Investors will have a look at those things and then they'll assess the risk of your ability to obtain or to take advantage of that opportunity. And they'll look at things like your likelihood of being able to deliver. Do you have the right people to execute on the plan, and so on and so forth. So when you're developing your vision for the future and you're comparing it back to what you currently got, the next critical step is to start the process of action planning. So action planning is about setting key objectives and then understanding what the critical success factors are for you to hit your future plan. Some of the key things that we're seeing and we use with our business is 90-day action planning, bringing it from long-term planning back to short-term planning. And the key aspect is understanding at all times, what are the risks in your execution and how can you mitigate those? How can you ensure that the investors understand that you're going to be able to deliver on the investment proposition you're putting forward? Okay, so in Todd's presentation, he stepped through some of these key strategy document elements. So some of the things that you're going to have to consider include the company values, what you stand for, and investors in the current day will look at your values. They'll look at, one of the key things that they're looking to do is make sure that they can trust that you're going to carry those values through post-investment. They can trust you, and they can trust that your business is going to continue to deliver. Understanding what your purpose is, and it's generally a people-driven purpose to service a customer, or also to assist your employees and people, whether that be family, yourself, or whoever it might be in your business, is the other thing that investors will take heed of. Understanding your target market. Who are you currently servicing, and who are you planning to service? What is your promise and guarantees that you're giving to your clients? And can you meet them? Understanding where you position your brand, if that's important to your business and the underlying purpose, and really getting your point of difference in the brand. So again, the critical thing when you're looking at investors is that you go from a situation where a lot of these things may be in a business owner's head, but you have to start documenting them. And the process of documenting these things will provide a certain level or a high degree of clarity to the business owner, and will probably test business owners for the most part if they're doing it for the first time. The other thing is that is to look at short and long-term horizons. Best example I've got of this is a situation, and we've been fortunate to have had two of our clients who have received investment in the last few weeks. Fortunately, probably just before everything got a little bit crazy over the last few days as well. But the critical thing is those businesses had historically not traded all that well, but opportunities had grown in their businesses, and they'd kept their eye on the prize and remained resilient through what is going to be what has been some difficult times, and those opportunities were starting to come ahead, or starting to come to fruition. So we're able to position the business in a way that investors believed in that future and were willing to supply what was the constraint and the ability of that business to deliver on its plan, and that was capital. So that we're hoping to see those businesses grow over the next 3 to 6 months through this period. But the critical thing is, don't assume that your history or your past is going to equal your future. And remember that the position of a business as it currently stands is not necessarily a deterrent to investors. And another example might be we've got a number of clients that compete against large brands in market. If what's an example? Say coming up against, say, your Coke of the world. Now, it's not necessarily imperative that business runs in the short term at a profit. What's imperative is the long-term view of that business, is that it will be profitable. The metrics over certain business types and the businesses that you're looking at entering into don't necessarily equate that you need to have profit in order to be successful in a capital raising journey. Okay, so business plan elements. This is in part to give you details of how much information that goes into a business plan and how much information an investor may require. Again, it's important to engage with your advisors early in the piece to understand whether or not this is going to be required by the investor, because the time associated and the costs associated with preparing these things can be large, and you may not get the return. So matching the amount of effort you put into these processes with the return is important. But having said that, going through these processes over a long period of time and starting early will give you a lot of value. I'm going to go through this in detail, but probably the critical thing that I've seen for our clients that have raised money is really understanding your business model. How do you deliver value to customers, and where do you sit in the supply chain? What do you do? And how do you want to be perceived to your clients? Okay, so when you come to action planning, There's multiple different templates and ways that people have done it. For the most part, SMEs starting at a relatively high level and with a template or a document that allows you to break down things into the top 3 to 5 priorities is critical. So one of the things we encourage people to do is, while the business plan and everything else is very important, but to use a document like a strategy on a page to really show that you've got some succinct thinking about your business and what you need to do to be successful. Okay, so because strategy is sometimes a little bit hard to know whether you've achieved an outcome and whether you've reached a point where your strategy is at a point where you've answered the key questions. Another thing that I'd suggest people do is just step through these 5 strategic choices. The 5 strategic choices came out of the executives at Procter & Gamble, and they viewed any strategy as being critical, or these questions as being critical to the development of any strategy. And if you haven't answered these questions, then your strategy is incomplete. So the first is to understand what your purpose or cause is. And why do you exist? What are you trying to achieve? The second is, where do or will you compete in the market? So the critical thing there is understanding what market segments, categories, what geographies, where you're going to play, what price points, where do you want to actually compete, what playing field. If your purpose or cause and the play is so large, and yet the position in the market that you're trying to play in is not, then it's critical you go back and reassess what your purpose and cause is. The next is, well, how are you going to compete? Who are you competing with, and how are you going to compete with them? How are you going to win? Again, if you've picked a market where there's competitors that are just not able to be beaten, and your purpose and cause is to be number 1 or 2 in that market, you need to reassess throughout the process. Once you've understood how you're going to win in the market, the next is to say, well, what capabilities or skill sets or competencies do I need in order to win, and to set them out. Again, stepping back and forth through the strategy. And the last is to understand, well, what management systems, what structures, what processes do I need to have in place, and what do we need to do consistently to deliver value to our customers and to win in the market. If you can answer those 5 questions and your strategy delivers on those things, then you can be assured that you've got a solid strategy. The next is about your ability to execute on that strategy. Okay, so as I said at the opening, the key risk area for any business owner that's looking to raise capital is financial acumen. Specifically, we've stepped away from needing to show that you've got a strong balance sheet and strong P&L historically and so on and so forth, because that's not always the case. Sometimes business owners will look at your business and they'll see things that you don't see, and sometimes the connection between those investors and you and the assets they have, whether that be access to market and so on, and various other things, or maybe the additional capital they're providing, they'll view that, they'll take a position and a view on whether or not that's going to provide sufficient value in order for them to realise their value proposition. So 4 elements. First is to know your numbers. The second is to step through your reporting, and particularly your profit and loss reporting. The third is to be in a position to review your financial performance and to build a financial roadmap. Okay, so knowing your numbers. So there's key 3 reports that you should know back to front. The profit and loss report, which talks about your income, your cost of goods sold, your gross profit from trading, operating expenses, your operating profit, your non-operating income and expenses and net income, your cash that tells where the cash is going in your business or coming from, and the balance sheet reports that give you a snapshot of your position of the business at a point in time. Okay, profit and loss reporting. The current day and age with the technology you've got, it's possible for you to use your profit and loss and view that profit and loss in multiple ways, but it's important for business owners to understand that the tax accountant report that you receive is generally designed to optimize tax. It's not designed to raise capital, in which case you need to ensure that you're understanding what is going into those numbers. important example of that is that assets can be amortised for tax purposes. The government's just released a write-off of up to $150,000, I think it was from memory yesterday, that you can write assets off and so on and so forth. That's going to result in a much lower profit and loss. And we've had circumstances where investors have looked at a balance sheet and profit and loss, and there's been significant additional costs to explaining to those investors and getting information about all the assets that a business has because they've already been written out of the balance sheet. There's often very little value in a tax-driven profit and loss in operating the business or in understanding what the drivers are of that business. Okay, the second report that we'll often prepare and work with our clients is the bank manager layout. Bank manager layout is really a high-level view and just providing the information to the bank that's required in order to either meet their covenants or to get lending for the business. It's not generally designed to provide management or owners with a lot of information about how they can operate their business better or indication as to how they're performing. The more important layout that you want to be focusing on with investors, and the thing that they're going to spend most of their time on, are tailored management reports. So what are the sorts of things you generally see with that? Look, grouping of income into categories and information in relation to your gross profit and cost of sales in particular. Grouping of all your operating expenses into key functions or categories. And information that's relevant to people that are operating the business. What are your employment costs? What were they budgeted against, and so on and so forth can be driven. And it's very easy to link your business owner layout back to the key drivers of the business and start to make decisions about what needs to be changed, done, and so on and so forth. Okay. The critical thing that we find has to change pretty quickly when people are starting to raise capital is the cadence in which they review their financial information needs to be much more often, and often rather than doing it either annually, monthly or quarterly with a BAS, we start helping people to look at weekly, monthly, quarterly and annual reports. Now, each time you do that, each business has differences, but what we've done and I want to show you here today is just an example of what might look in terms of a checklist process that you might step through and what you start looking for. So on a weekly basis, you really want to be updating your cash flow forecast and your plan, and making sure that you've got a really good indication as to how cash is flowing through the business. It's critical to things like supplier relationships. It's critical to getting the best terms with those suppliers and with banks and so on and so forth. It's mostly critical so you don't get that surprise and that shock that happens when your BAS comes and you don't have enough money to pay it. Or your payroll is about to come up and you're having to go and reach and find other methods in order to make those payments. We've had situations where people are getting surprised and they're having to use their personal credit cards to make payroll requirements. And some of those things happen with profitable businesses that are growing, that just haven't managed their cash flow. So weekly, it's important, I think, to manage your cash flow. Staying on top of your accounts receivable and accounts payable is also critical. And then once you've set your targets and you understand your margins and your pricing strategy, really checking your sales, income, and your targets weekly becomes a key focus. On a monthly basis, you really want to extend that out further. You want to look at your balance sheet. You want to have a look and make sure all your main reconciliations are being done, and your accruals and everything are being picked up at that time. That'll give you the opportunity to see not only the performance of your business over the month, but also where you're sitting financially in terms of the position in the balance sheet. On a quarterly basis, it's really about understanding some of the bigger ticket items like tax, GST, pay-as-you-go withholding, and getting ready to make those payments. But it's also an opportunity to step back, have a look at your forecasts, which should have been prepared from an annual, or your roadmap, we refer to it as. Step back and consider whether or not you need to do some reforecasting, whether you need to change things, or whether everything is on track. At the moment, as an example, the a number of our clients are going back and having a look at their forecasts for the US to Australian foreign exchange rate. If you're an exporter, that's a really great outcome. If you're an importer, obviously not so much. But it's causing the need to stop back and look at these things. So while we've suggested that we do it quarterly here, in some circumstances you might need to do it more often. I'd say now would be one of those times. From an annual point of view, it really is about resetting your strategy, getting income tax returns prepared, staying on top of compliance, and resetting your budget, getting ready for the year ahead. Okay, so financial roadmap. Financial roadmap is really a budget, but it's not your traditional view of a budget. The critical thing with a financial roadmap is to get a baseline understanding of the key drivers of your business, a bottom-up view, so that you understand as a business owner what drives your performance. Okay, so building a budget from the ground up is one of the more challenging things we do with our clients, and really them understanding things like the number of clients they have, the drivers behind their costs, what's going to drive performance is one of the things that they find more difficult to get their heads around. But once they do, the power that we see or the empowerment we see with our clients to be able to understand what's happening in their business and coupling that with real information on an ongoing basis is critical to them to gaining their financial acumen, and really to having confidence when you speak to an investor and saying, well, look, if the exchange rate moves from point A to point B, this is the impact on my business. However, we don't expect that to go over a long period of time, or these are the things we've put in place to ensure that if that happens, then we're protected on the downside. Some of the other things that you can do during this process is to understand, well, look, if we increase our sales or our pricing by 1 or 2%, and we reduce our costs by 1 or 2%, and then our operating costs, what's the impact on the P&L? And generally that kind of an exercise with a client results in them getting really surprised by the impact on their overall financial performance of the business. And depending on the size of your business, it can end up being, whether it be tens, 15s, 20,000s of dollars of change for relatively small changes and relatively small tweaks. Once clients understand that, and once a business owner sits back and thinks, well, okay, can I increase my price by 5%? What's that going to do to my customers? And in some cases, it increases profit quite drastically, because the customers that have been trying to get discounts and only deal with you during promotion times and so on and so forth, they'll drop off, and other customers that are more loyal to you and understand the service and product you provide is of value will stick by you throughout those processes. Okay, again, understanding business drivers will be important through the process. An investor will look to you to be the key source of wealth of knowledge in terms of your business. That means that they'll start off a low base of knowledge. Maybe they'll understand the industry, but they won't understand your business. So if you understand what goes on within your business, what the tweaks are, what happens with people's engagement and how that impacts your revenue, what happens if you employ a new salesperson to your revenue, what's the likelihood of increased sales over the next 6 to 10 months, that's the sort of information that they're going to want to understand. Helps you build out the story, and it helps them to gain trust in your ability to manage the business. Probably one of the critical things in that, and understanding what investors are looking at, it came to our attention. Maybe if we go back a year and we look at one of our winery clients that was looking to get investment in, so they had some expansion options ahead of them, and they spent probably 2 to 3 years in advance of that when they came to us, and they'd spent 2 or 3 years really working on their operational aspects of the business, getting the right people in place to manage the business, putting new processes down, mostly around the back end office aspects of the business, and driving home what are the drivers of their business at that time to get performance from a P&L perspective. What became interesting is they hadn't engaged with the investor throughout that journey, only really to find out later that investor was not really focused around their management team, because they already had processes in place and they already had management structures in place, and they knew what they would do. They were going to do the processing of the grapes at that point in time themselves. So all they were focusing on was the yield coming out of the winery itself, or out of the vineyards there in that case. So early engagement with the investor will help you focus on the business drivers that they're focusing on. Obviously, you still want to run a business profitably, or as profitably as you can, and in the circumstances. But in this case, I don't think the investment they made in operating a better business actually derived any great outcomes for them in terms of getting the investment. Just something to keep in mind throughout the process. Okay, the world of financial tools has changed massively over the last 3 to 4 years. Our ability to give real-time information that's linked back to your accounting system has really strengthened with you being able to get not only historical information, but forward-looking forecast information that helps you understand your business better. The tools are endless at this point in time, and some of them work very, very well. We've taken an early view and used all these tools and trialed them with our clients, and have particular strength in understanding when they can and do and don't work. There's always limitations, but they are very valuable tools if you know how to use them. Some of the information that you can get out of them, as an example, are scorecards and report packs that provide you with snapshots in real time of where your business is going. Probably one of my favorite tools at the moment is this report, which comes out of a tool called Fathom, and it provides you a detail and snapshot of where your break-even point is, where your margin of safety is. In this case, it says that you can you could reduce your sales by $417,000 before you hit break-even point. But it also tracks things like your cash flow forecasting and so on and so forth, and gives you what I think are relatively appealing visual diagrams of what your future looks like and what your financials look like. Business owners that have put these in place and they get them in real time, really, once you've put 3 or 4 of these in place, and once you've got dashboards there, that you become really hungry to see more of them. So that closes out the financial side of the business. Obviously, your profitability will drive the value to a degree of what your business is worth, depending on the circumstances. It could be sales and size and all the rest of it. Everyone is different, but it's critical that as a starting point that you have a really good handle on the day-to-day management of your business financially. So from a legal standpoint, we're not going to focus too much on the transactional issues that happen when you come to raise capital, and there's a number of those that will have to be considered, and we'll consider them during the masterclasses. However, what we will focus on today is the legal structures that you can put in place, and how that impacts on your value you take out of the business first and foremost, but also in your ability to attract capital from investors, and some other key things like tax. Okay, so from one of the critical things that you need to consider in considering your legal structure is your tax. So we probably step through a 14 or 15 step process when we're considering legal structures, but one of the critical ones obviously we focus on is tax. And really what we're looking at when we're looking at tax is, well, what is the timing of income distributions? Do you have the ability to defer those income distributions and start to accumulate your wealth within the structure? So absent of tax evasion or tax havens, whenever a business generates income, at some point in time, an individual is going to have to pay tax on it. The key thing with the timing of income distributions is, does your structure allow you to defer that point in time until a later point? So the company tax rate, depending on your marginal tax rate, is generally lower than the individual marginal tax rate. So you want to avoid having to pay tax at a very high rate while your business is still growing. Now, the next thing is the allocation of income distributions. So where you're in a situation where you've got a company, say, or an individual that runs a business, you've got the ability within your structure to allocate income distributions in different ways provided you have the right structures in place. A lot of accountants and our key methodology in being able to distribute income to the taxpayers we want is in the use of trusts. So the discretionary trust allows you to distribute the income to the beneficiaries of the trust in the way you like, depending on your income distribution. Whereas if you're an individual operating a business, that individual will pay tax on that income. Or if you're a company that derives income and wants to pay a dividend and an individual owns that share, then that individual is going to pay tax on it. So allocation, the ability to allocate the income distribution in the way you like is probably the second thing, and having flexibility around that. The next is really we step back and think about what's the ability to preserve the income type that has been generated. And typically what we'll focus on in that circumstance is either franked income or capital gains. But if we focus on capital gains, if a capital gain is made, so if a company owns a property or a capital asset and it sells that asset, that company won't get access to the CGT concessions or the 50% discount. So once that income goes into the company, it will be treated as normal assessable income, and then when it leaves the company, it'll be a dividend like every other form of income. Whereas in the case of a discretionary trust, the discretionary trust will receive that capital gain, and that type of income will be preserved, and you'll be able to distribute that capital gain through to the beneficiaries. Certain limitations, but the other things we start to think about is the state-based taxes. So when we're looking at planning, we say, well, what are the state-based taxes that are going to be in play, and what's the likely impact of the structure on them? In addition to that, we give consideration to things like your R&D concessions, your government grants, other incentives, where in some cases those incentives are only available to entities of a certain structure and typically companies. So we need to give consideration as to whether or not the taxpayer or our client is likely to use those concessions and whether they're available. In terms of access to capital, the next step is really to go and make sure that the structure allows you to get access to capital. So sole traders, partnerships can often create challenges when it comes to accessing capital. Investors do typically like the protection that companies provide, where there's existing rules in place in the Corporations Act that protect them, and it's a known structure. So the other thing we give consideration to around your capital raising journey is, if you're going to raise capital, let's ensure that the capital raising structure is going to be flexible enough and trusting enough for the investor to want to invest in your business. Okay, the critical thing to understand when investors are coming on is there's a few elements to it. It's not just raising capital like you do from the bank and the banks walk away and let you operate the business. Sometimes investors will want some level of control or visibility into the business and the business operations. Not always, but sometimes. So the other things we give consideration to is, what are the control mechanisms that are in place for the structure that you have? What governance is in place? And then we really offset that against the cost of the structure that is there. So a company structure is typically more expensive to manage and maintain than a trust structure, and definitely more so to set up, manage and maintain than a partnership structure. Administration costs and requirements are higher again in companies than they are in other structures. And the last thing, well, not the last in order, but the last thing we talk about today is asset protection. So what asset protection typically is about is where we look to manage the liabilities, which can extend anywhere from a limited liability situation, such as a private company, through to an absolute liability situation, such as a sole trader, where any liabilities that you incur as a sole trader will fall on you, whereas in a company that you're limited to the assets of, typically you're limited to the assets of the company. Okay, so that's great. I think it's important then to see this in a diagram and to step through what this means and the decisions that you're going to make in the process. So if we step through and say which of these entities is a separate legal entity, a sole trader is not. A sole trader is you operating the business, and therefore you carry all the liabilities associated with it. A partnership is also not a separate legal entity from the partners. A company is a separate legal entity from the individuals and is recognised as essentially as an entity or as a person for the purposes of tax and liability. Discretionary trusts and unit trusts are commonly thought to be separate legal entities, but they're actually not. A trust is a legal relationship, or is not a legal relationship, is a relationship between trustee beneficiaries in relation to assets, and it's not a legal entity. The legal owner of assets of a trust are its trustees. So in terms of control, which is one of the other things that we look at, where you're a sole trader, it's obviously an individual that controls the business. You make all the decisions. You can do essentially anything you choose. In partnership, oftentimes you'll have, depending on the partnership arrangement, each individual will be able to have that same discretion to operate. And what that means is that you're supplying that partner with a large degree of trust. And what it also, I suppose the flow and impact of that is a partnership, you end up with an unlimited and several liabilities. So if one of your partners in your partnerships incurs a liability, then you may be held responsible for the payment of that liability in the event they don't make that payment, something we generally try to avoid. Companies, on the other hand, they have limited liability, have lower tax rates, but on the negative side, they don't get access to things like the CGT concessions. When we look then through to saleability of these structures, from a sole trader perspective, it's very, very difficult well, you can't sell a sole trader, but you can do is sell the underlying business assets. Partnership, again, you can enter in or bring in a new partner to a partnership, but there's a number of legal issues and challenging issues associated with liabilities and tax associated with doing so. You can trigger tax consequences of doing that, and as a result, the saleability of a partnership can be considered quite low. A company, though, you have multiple options. You can sell the business operations and or the shares in a company. There's a known structure, and there's ways and means in which people can reduce their risk on their way in the investment. Discretionary trusts, well, we've shown them as medium in terms of the structure, and critically, I think the important point there is there's different things that can be done with discretionary trusts, not necessarily in selling discretionary trust itself, which can't be done, but in the way that you can form partnerships and do other things in order for that structure to be used going forward. So to give some context around some of the key considerations that we look at and the way we view structures with our clients, I think it's important to look at a couple of different examples and to put some and to step you through some of the issues that you're seeing. So if we focus on structure example number one, in that circumstance, we've got a company structure in place. That company structure employs people, operates the business, owns plant and equipment, and also has land and capital assets. Now, if we step through the key criteria and start off perhaps at asset protection, having land within the business operations, which may or may not have value, but typically and hopefully will be an asset that increases in value, means that in the event that the business starts to struggle financially or incurs liabilities, the risk is that in the event that something happens and the business fails, then all of the business assets, plant and equipment, and the land will potentially be at risk. Now, stepping up higher, and you look at the company structure and say, well, okay, what's the flexibility in around the income distributions coming out of that company? And we've got two different types of shareholders. So as that company looks to pay dividends, so it earns profit and it can hold that profit in the company without the individuals or the family, without the individuals having to pay tax on it. But at some point in time, you look to pay a dividend. Now, the company, when it looks to pay a dividend, in this circumstance, has an individual shareholder and a family trust. So to compare the difference in the outcome, if the company pays $1 million dividend out of $1 million each to each shareholder at 50% each, the individual shareholder will pay tax at its top marginal rate, currently of effectively 47%, whereas the family trust will have the ability to distribute that income to multiple beneficiaries, and as a result, may get significantly lower tax rates than the first. Now, in structure example number 2, we've got a family trust that's operating a business with plant and equipment and so on and so forth, and then a separate family trust that holds the land and is leasing that land back to the first family trust. We've got joint trustees, one being an individual in the company. So if we start off, first of all, the first thing to note is that you've got a separation between the two family trusts, and what that provides is in the event that of business failure, or alternatively, if there's a loan or debt over the land, it protects the land from the business operations in the event of failure, where the creditors won't typically be able to see through those structures in order to, or we attempt to have it where they can't come and get all those assets at the same time. Now, the family trust, call it family trust number 1, has joint trustees. So the next thing the reason for a structure like this, to put it into example, is to protect the assets, and typically a family trust the trustees will be indemnified from any liabilities of a family trust up to the total amount of assets that family trust has. Any shortfall from that will typically fall back onto the trustee. Now, where a company trustee is in place as compared to an individual trustee, that will mean that company, in the event of a shortfall of assets, will be liable to pick up and pay those liabilities. And obviously that's advantageous, particularly if that individual holds other assets, because if the individual trustees has assets and there's an insufficient amount of assets within the family trust to meet the liabilities, then there's a risk that that individual will be required to liquidate assets that they hold individually and to meet those obligations. So I hope that gives you a bit of an understanding of some of the things that we look at when we're looking at structuring. I think the critical thing then is to understand that transactions have tax consequences, and the three of the key tax consequences we look at during a transaction, whether that be an asset sale or a capital raising, is what's the capital gains tax implication, what's the income tax implication, and what's the impact on duty. So capital gains tax typically is imposed during a transfer or sale of a capital asset. This can include real estate, shares, goodwill, but it can also occur as a result of various other transactions or events that occur. The critical thing is that there's various concessions available for capital gains tax, where you can reduce or even eliminate that tax, and the structure that you choose will impact on whether or not you can be successful in getting those concessions. We'll talk a little bit more about those in a few moments. Income tax is tax which everyone will be aware of, imposed on assessable income such as business income or dividends. One of the things that people may not be aware of is that changes in your structure can actually trigger taxing events on income tax. So it's important, or for income tax, so it's important to step back and understand what those consequences might be before entering into transactions. And duty can occur during a transfer of, or will occur due to the transfer of dutiable property. People will sometimes forget that. What the impact of that is that selling a business compared to selling shares, selling a business you will incur duty, at least in WA, and whereas if you sell shares, you won't. Okay. So we're going to get into some of the tax concessions now, and so you can understand the importance of some of these and the impact it can have, and then we'll talk a little bit about restructuring. Okay, small business CGT concessions. What are they? Look, these are some of the most, or probably the most attractive concessions in the Tax Act, in that you can eliminate very large amounts of gains as a result of capital gains all the way to zero, and you'll pay no tax on it. The measures as a result of being so concessional are massively complex, and there's a large degree of risk in not applying them correctly. But having said that, they're there and they should be used. So just to run you through the concessions, the first concession is a 15-year exemption, which relates to which will essentially allow you to eliminate a capital gain where you've held an eligible asset, and if you're an eligible taxpayer for more than 15 years. Now that's what we refer to as a holy grail. Gets you no tax on large amounts of income, and there's very limited things that you need to do in order to achieve that beyond being eligible. The next is a 50% active asset reduction. That's similar to the CGT discount, which is also available, will reduce the remaining gain after the active asset discount, after the CGT discount by 50%. Now, in addition to that, there's also a retirement exemption, a rollover exemption, which we'll step through in a moment. And we've just stepped through some of the very high level eligibility requirements you have in order to meet those. The first being that you're a small business with aggregated turnover of less than $2 million. The second being related to the amount of net assets that you have in being no more than $6 million. So the first thing that comes to mind, and particularly if you're in a situation where you're selling, where if you're on a farm and you're selling assets, let's say you've got livestock. That's probably the easiest situation to look at. Oftentimes the farm will kick you over more than the $6 million net asset tests. So in which case then because this is an OR test, so you have to meet one or the other. So you then have to fall back on the $2 million turnover test in order to be able to satisfy these concessions or the eligibility criteria. Now, one of the errors that can sometimes be made is that people will hold large amounts of stock, and when they go to sell their business, they will, as part of a transaction, sell all their stock in one transaction, or all of their livestock in one transaction, and that will often trigger a situation where they go over the $2 million threshold, and that can push you out of these concessions. There's a myriad of other examples of situations that you need to be mindful of and considerate of when you're looking to restructure and or sell your business. But the critical thing there is to understand that they're complex concessions, or the complex eligibility criteria, but the concessions are very, very attractive if you receive them. To give an example of where this happens, in this case, we've had we're showing an example of a business that sells their assets for $5 million, with a cost base of $1 million, so they get a gross capital gain of $4 million. Applying the CGT discount, assuming that applies, you reduce the capital gain by a further $2 million. The remaining gain then is $2 million, but you can then further reduce that by the active asset reduction by $1 million. Now, at that point in time, you could potentially, if there's only one person available, gain access to the retirement exemption, which is there's a lifetime limit of up to $500,000. If there's multiple people, you could gain access to that retirement exemption by using those, and potentially reduce that capital gain down to zero, or in this case, we're showing it at $235,000 at the top marginal rate. The alternative view of not having those concessions is that you end up paying $940,000 worth of tax. So there's almost $1 million difference in the tax outcome, depending on what concessions are available. Obviously, very attractive if you can achieve them. Okay, so one of the things that we've been massively involved in the last 8 years is really the startup community and focused on technology. And one of our people in Adelaide spends all of his time working on agricultural technology at the moment. And one of the concessions the government has put forward is the early stage innovation company incentives. what this is about is really encouraging investment and capital into the technology space and pushing R&D for increases in productivity and so on and so forth. But to give give you an understanding of what this means, if you do have an idea that you're looking to build, and if you're in that startup phase or you're in that innovation area, is that when you go to raise capital, it's possible for the investor to receive an offset of up to 20% to a maximum of $200,000 if they're sophisticated investors for an investment of up to $1 million. So where you're looking to raise $1 million to get something off the ground, an idea, and so on and so forth, if you're competing in a market for capital and the capital investor is looking at a cost of either $800,000 investing in you as an ESIC eligible company or $1 million, it means that you as a business owner can give up a lot less of your business if you're an eligible company. And that really does encourage people to invest into you as a comparison. In addition to that, if the investors and if you're successful in growing the business and the investors sell out of their business within a 10-year period, they actually won't be taxed on the capital gain. So it's very attractive, and we highly encourage, and we've done a lot of work in this space, so we highly encourage anyone who wants to know more information about this space to take advantage of it. Okay. Okay, one of the factors that we see with investors and what makes them really concerned is if you have massive hygiene or compliance issues along the way. We've had, I think, showing an attitude of compliance and showing an attitude towards compliance that's very strong is important. We've had situations in our M&A team where investors have walked away from investments where they've found out that the ATO compliance, as an example, wasn't maintained, but the investors were, the business owners were a little bit blasé about what that meant. So I think it's critical to make sure that, or to ensure that you're in around these hygiene factors. And we will be including a DD and investor ready checklist along the way that can help you understand what that means. I might just stop there for 1 second because we have just had a question come through, and the question is, can you raise capital in a discretionary trust? And the basic answer is no. You can't raise. You typically wouldn't raise capital in a discretionary trust. Just highlighting it, that's one of the critical things around the structure. You wouldn't typically have a situation where you raise capital in a discretionary trust because of the discretionary nature of the distributions and the inability to push the income distributions back to that person. Come back to the compliance. So some of the key issues that you want to look at there is making sure your tax returns are lodged, activity statements are lodged, FBT issues are dealt with, and critically that shareholder agreements. So family businesses and small businesses will often have situations where the shareholders or business owners will provide capital to the business and or take capital from the business other than in the form of wages or dividends, and tidying those things up before investors come in is critical. So having shareholders agreements in place, having all of your other key hygiene factors like rental agreements in place if you're renting from a related party, they're critical to get done in before the investors come in, because oftentimes those investors will then be involved in the negotiation piece post. And you don't want to be in a position where you've got an investor come in that's then turned around and said, no, I'm not happy with the market rent that I'm paying to essentially a related structure and wanting to reduce it. Okay, so I've been in the last week, and when we were closing off the capital raising for one of our clients last week, one of the things we had to do is go in and negotiate with the ATO in relation to obligations of our client in respect to their superannuation guarantee reporting requirements and other ATO obligations. So as a result of single touch payroll that hopefully everyone is now doing and is understanding, the ATO's information and their reviews are increasing, and it was very clear during my meeting with the ATO that this is going to be a focus area of them for the next 12 months. Now, that may have changed over the last 24 hours with the announcement of a $25,000 rebate for pay-as-you-go withholding paid on the BASs, but at least as of last week, that's a critical focus. Okay. Okay, when you're considering restructuring, the critical thing here is to do it early. Trying to restructure when you're in a situation where the opportunity is there, but you're running out of time and to get things done and you're at risk of losing it is not a good time to restructure. So as early as possible is the critical thing to focus on here. There is rollovers available, and there's a number of rollovers available or concessions available in respect to restructuring. Again, a lot of these require a good deal of planning. There's large tax issues associated with them, so it is important, again, to consider doing that early. Also, to do it properly. We've had some horror situations come through with new clients where the structure that they've used to get investors in wasn't done correctly, and in some circumstances we've had situations where we've advised people post-transaction and they've paid double the amount of tax that they should have. So that's as a result of restructures being done just before a transaction and them not seeking proper advice or controlling the situation. Okay, so I'll come back to a couple of the questions we've got in a moment, but in terms of just rounding out what it means to become investor ready and the process again, the first step is really to assess your readiness, and we're going to have tools available to you through DeepHerd on their website for you to start to do that. We're also happy to work with you and your advisors in reviewing that, and happy to give you our time if for anyone that would like it, to assist you in assessing that or basically starting the process or starting the journey and the action plan that you need to do in order to make decisions to become investor ready. Start the process of looking at your fundamental elements of investor readiness. Again, the checklist will be helpful. You work with your advisors and then understand the capital raising process, which is not an easy journey. I've kind of constantly get surprised at how difficult it can be at certain times, but what you're dealing with is you have a really good knowledge of your business or the opportunity that you're trying to create, and trying to take that out of your mind and give that to another person, and also get them to trust you with those funds and trust that you're gonna act in their best interests, and also to get them to believe in the journey and what you're trying to achieve is very difficult. And I think it's important then to have advice as early as you possibly can. The next thing is really remember that you're doing this to grow and expand. If you're going to get an investor in, you don't want to think about it as them carving up the pie that you currently have. You really want to think of it as you're trying to increase the pie. The main thing I then say is to step back. We use the dance floor and balcony analogy and say most business owners spend way too long on the dance floor, and they don't get to step back and get into the balcony and really have a critical view of their strategy and of their business execution, or really take stock of what they're trying to achieve out of their business. They oftentimes business owners will start having a very clear picture of what they're trying to get out of a business, but then they lose track of that once they get into it. Okay, now Sarah is going to take you through some of the upcoming events, and thanks. I will step away. But Danny, thank you for your time. Good luck with the next few months. I hope the coronavirus settles down and we can all focus back on business as soon as possible. And if you want to reach out, I look forward to hear from you.
Thanks, Danny. If you do have any questions, Danny will be around for a little bit longer, so feel free to send those through while I just tell you about the upcoming events. I've just got to get to the next slide. Okay, so the upcoming events. So the next and final webinar is with Margot. So that is where she's going to apply the principles that Todd and Danny have just been through in the last 2 webinars with a live case study with her client. Once the webinars are over as part of this investor readiness program, we'll kick off the regional masterclasses. So they're going to be in Busselton and Geraldton, and they will run in April, May and June. So there's 4 of those. They're going to be very practical all-day sessions where we'll take you through the steps of the investor readiness program, and you'll apply it to your own business and receive tools and resources in either starting or continuing this journey through investor readiness. A separate event that is coming up and is at a BDO event, which I think will be of interest to people. It's a webinar on choosing the right business structure for your family farm. So that's going to be held in a similar format to this. So it'll be a really good event that I think if you're interested and you're in the agricultural industry that you should take a look at. If you do want more information on it, you can head to the BDO website and search choosing the right business structure for your family farm. Would really recommend that one. That's coming up next month. And just before we sign off, just wanted to speak a little bit about the Department of Primary Industries and Regional Development. We're doing this program in connection with them. Their role is to ensure that the regions are key contributors to the government's agenda. Their goals are to protect the industry and help it grow. So would really recommend, if you're in that industry and you need some assistance, reach out to them. They're a great source and help for your businesses. They have worked with us in conjunction to bring this program to you. So there's going to be some great printed material on their website, and they'll be helping us bring the masterclasses to life. So if you do have any questions on them, I highly recommend reaching out to them. I don't know if we have any more questions. I think that's it for us. So thank you for joining us and enjoy the rest of your day.